Good morning.
Hey. Morning, Ken.
I can't hear you, Ken. Try. Dean, can you hear Ken?
No, I can't. It's just you and I, Ned.
I'm not hearing Ken.
All right. Here he comes. How are you, Ned? Anyway.
It's fall. It's nice. I'm a fall person.
Right.
All right,
so
can you guys?
that's lovely. Yes.
buddy.
Yes.
Sorry about that. I don't know what happened. I kept hearing the start music and it just kept looping in my headphones.
Yeah. No, I can hear it now.
All right, good. Well, sorry about that, everyone. Welcome to our DAT IQ weekly market update.
Welcome.
Good morning. He's gone again.
No. What's No, I heard you. I just heard you. Oh boy. Try muting the producer and Adam in the background, and that helped for me because I was hearing that same reverberation.
All right, so we're going to try this again. So sorry about that, everyone, having some technical difficulties. Welcome to our DAT IQ weekly market update. This is our update for September 21st, the last day of summer, even though you'd never know it, judging by the flannel. It's cooled off here in Ohio. I'm Ken Adamo, Chief of Analytics here at DAT, joined by Ned Damon, who's our Principal Data Scientist, and Dean Croak, who's our Principal Industry Analyst. Welcome, guys.
Good morning.
Yeah.
Good to be here.
Yeah.
A lot going on out there, huh? Things seem to be a little bit busier than normal.
Yeah. A little bit.
Right.
A little bit.
Well, we have a lot going on, both at DAT and around the industry. Just a couple of quick things to talk about. We have folks down at CSCMP this week. So if you're at that conference, recommend you stopping by and seeking us out and saying hello. Also, the TCA conference is in Vegas this week. And Dean will talk about some of the stuff he's doing from a media opportunity standpoint later this week. I'm going to open us up with some of our key points of the week and get rolling. So Dean's going to talk about this a lot more in his update, but we have rates for dry vans and reefers continuing to test or exceed records and expectations. Dry vans continue to be above 250 a mile, which was that prior resistance level, and that's well before when we'd expect them to start cresting up heading into peak. West Coast imports are the main story. Frankly, we're kind of tired of talking about it, so we have a bit of a different question towards the end of the show, but it's worth mentioning, and Dean will cover that in his market update. But if you've seen any of the pictures in Southern California of the boats at anchor and the drone footage, or people kind of flying out to Catalina Island, taking pictures of the boats, it's just insane what's happening out there. What we are going to focus on later in the show is fall produce season. It's remained very strong. It's evident in the reefer volumes and rates. We got broccoli, apples, potatoes, pumpkins, blueberries, all of that fall produce. And then very successful wrap to Driver Appreciation Week, Convoy for Kids, all of the stuff happening all over the country. It was a really great week to thank our drivers and show our appreciation. So with that, I'll turn it over to Dean to move us to the update.
Thanks, Ken. Let's start off with the load board activity. Let's have a look at the dry van loaded truck ratio. As you always see after the Labor Day break, volumes recovered, still down 7% compared to the week before Labor Day break, though. So a little bit of a downward trend over the fortnight. Equipment posts were back up to 10% week over week. A lot of carriers came back into the market. So the net effect on the dry van loaded truck ratio was a slight decrease from 6.18 to 5.96. In the refrigerated loaded truck ratio sector, volumes increased by 9% last week, still down 2% month over month. Produce volumes on the domestic front still declining as they do seasonally, down 15% year over year. Equipment posts increased last week by 2%. So what that did to the loaded truck ratio was increase it from 12.59 to 13.55. And in flatbed, it's the only one that looks like seasonally behaving normally. As we lead into fall. A busy hurricane season, of course, has resulted in a lot of rebuilding effort, pushing more volume into the market in the southeast region in particular. Saw a similar thing in 2017 in the month of September when the two large Cat 5 hurricanes made landfall, so very similar to that year. So last week, the flatbed load-to-truck ratio increased from 42.55 to 46.85. And in the market condition index, we'll start off with some of the data that Ken talked about on the import port congestion side off the West Coast. Port congestion is breaking daily records. We've had 70 vessels at anchor this morning, according to Kip Loudon at the Marine Exchange, waiting on average 8.7 days to unload. Federal government's now involved in trying to expand the working hours with all the different stakeholders. What we're seeing, and this typically happens on a 10-day to 2-week lag, is once the vessels start to bunch, we see a lot more volume hit the spot market. So out of the Los Angeles freight market, spot market volumes were up 41% last week. E-commerce volumes are very dominant on some of those big lanes. Stockton up 35%, Atlanta 22%, Dallas up 24%. And on the big intermodal lane to Chicago out of Los Angeles, volumes are up 23% week over week. The biggest volume lane for the spot market out of Los Angeles is Stockton, just east of San Francisco. Rates jumped 41 cents a mile last week, averaging 432, only 338 miles, but it was a new 12-month high, and $1.18 a mile higher than this time last year. Jumping over to the East Coast, Philadelphia port shut down just after Labor Day for 3 days to clear the backlog of shipping containers. So as a result, truckload volumes were up last week as that volume started to come back out of the market. Rates continued to increase, up 4 cents a mile last week out of Philadelphia. Loads from Philadelphia to Chicago jumped 31% last week. But the capacity was pretty flat, staying around the $2.01 mile mark, excluding fuel. Having a look at the refrigerated market, as Ken mentioned, lots of fall shipping volumes. We've got broccoli coming out of northern Maine, apples out of Washington. Truckloads out of Washington are averaging about 1775 loads per week. Potatoes from Idaho and Minnesota. In Minneapolis, spot market volumes were up 27% last week. And with the potato harvest underway, reefer rates increased by 28 cents a mile week over week to an average of $3.42, excluding fuel. And of course, Halloween is just around the corner. You've no doubt been seeing pumpkins everywhere. The major growing region is in Rock Island, Illinois. Shipping volumes were up 13% last week. Spot rates out of Rock Island increased by 42 cents a mile to an average of $3.86. Loads of pumpkins from Rock Island to Hunts Point, New York, hit a 12-month high of $4.27, excluding fuel, while loads west out of Rock Island to Denver increased 23 cents a mile to an average of $4.03. Still lots of solid loadings coming out of the Salinas Valley for iceberg and romaine lettuce. They're running at about 1,875 truckloads a week. So still strong volumes out of the West Coast, as we always see. Having a look at the flatbed market condition index, and of course the flood ravaged Gulf Coast region keeps our attention on the spot market in flatbed. Last week volumes eased slightly. They dropped by 2%, not a big drop, but that was following the prior week's 31% week over week increase in inbound volumes into the Gulf Coast region, mainly New Orleans. Shipping volumes appeared to get back to normal volumes after 2 very slow weeks after Hurricane Ida. Load post volumes surged 78% week over week last week. Plenty of capacity in the market. Spot rates stabilized, but they're down $1.47 a mile to $3.08, excluding fuel in New Orleans. They did peak at $4.55 a mile in the second week after Hurricane Ida made landfall. And again, out west in Reno, Nevada, capacity is still very tight. Spot rates jumped 20 cents a mile last week to an average of $3.12. Loads from Reno to Seattle remained very high at $3.73, up 8 cents a mile last week. So wrapping up our weekly market update with the year-over-year look at dry van spot rates. Following last week's, or the week prior actually, 5 cent mile increase right after Labor Day, dry van spot rates remained flat last week, staying at $2.51 a mile, excluding fuel. Compared to the same week last year, they're 35 cents a mile higher. Looking at refrigerated year-over-year spot rates, taking the lead from dry van sector, reefer spot rates also increased, but by a little bit more. They were up a few cents the week prior, up again 3 cents last week, averaging $2.84 a mile in the reefer category. That's excluding fuel. Still 48 cents a mile higher than this time last year, and still showing signs of increasing as fall produce season gets into gear. Flatbed year-over-year rates, movement in the flatbed sector has been fairly consistent over the last few months, moving up a penny per mile one week and down by the same margin the next. So following the penny per mile increase the week prior, flatbed rates dropped by 1 cent per mile last week to a national average of $2.64, excluding fuel. Flatbed spot rates are still 46 cents a mile higher than the same week last year. And compared to our last time we had a big flatbed rate rally in 2018, this week's flatbed rates are 49 cents a mile higher. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly freight report. And that's it. Over to you, Ned, for the short-term forecast.
All right, we're going to be starting off by looking at dry van forecasts. So you can see in blue the market rates observed by DAT in the past couple of months. And then off to the right, you can see our forecast models. In green, you can see our ratecast models, expecting there to be a little bit of growth still left in the dry van sector, going up about 7 cents, it looks like, peaking in the middle part of October, and then pulling back down just a hair as we head into the middle part of October. The short-term model is expecting more or less steady as she goes, with rates not doing a lot of movement, but a small downward slope to the overall trajectory, dropping by about 3 cents heading into the middle part of October. In the middle, in gold and silver, you can see our two blended forecasts, which are mixtures of the two forecasts in different amounts in different ways. Here you can see there's a little bit of divergence where the gold blended forecast is leaning a little bit more towards ratecast and the silver blended forecast is leaning a little bit more towards short term. Overall, I would expect there to be more upside than downside risk heading into October. Normally there's a strong seasonal pattern, and I see no reason to doubt that we will expect to see at least a little bit of that seasonality heading into the next month. Moving on to Reefer, once more you can see in blue the market rates observed by DAT, and then off to the right you can see in red the short-term model, which is expecting continued strong growth, looks like about 10 cents ish moving into the middle part of October. Ratecast is expecting a little bit of growth mimicking the short-term model, but then breaking and heading more downwards to flatten out at about current levels by the middle part of October. In the middle, you can see the two blended forecasts are leaning more towards the short-term model, and I think it's going to be really interesting given fall produce season to see what exactly is the outcome as we move through these fall months. Finally, we're moving on to flatbed. Here you can see in blue the market rates observed by DAT, and then down at the bottom, or bottom right-ish, you can see the forecast. In green is our flagship ratecast forecast, which expects a little bit of an uptick before it heads back to about current levels by the middle of October. And the short-term model and the blended forecasts are leaning more towards the short-term model here, are expecting pretty much straight down to the right as we go through for a drop of about 7 cents as we head into the middle part of October. This is it for the forecast, and I think we're ready for our Ask IQ question of the week, which is, what's the outlook for reefer spot rates now that fall season shipping volumes are picking up?
That's a great question.
Yeah.
Something tells me you're prepared to answer it, Dean.
Yeah. It's one of those strange markets. I was with a bunch of carriers on the weekend at a truck show, and now they're kind of mixed results. Some of them were opting to run dry freight because the rates were so high and they didn't have to deal with the hassles of multiple pickups on farms for produce and then live loads and unloads and all the liability that goes with hauling fresh produce. So that's one factor that kind of caught me by surprise. There has been some extension of produce markets regionally because of the weather that we've had. In some parts, we've had a lot of rain, too much rain in some places. That's delayed people getting into harvest. Other areas, we've had not enough rain, which has damaged the yield. So it's been a real mixed bag so far over the summer and into fall. But I think what we've seen being the case for the last 18 months is that it doesn't take much to disrupt a market. And this capacity was already very, very tight. And so what we're seeing is some of this regional push of fall produce is starting to stretch capacity in those markets where those farms are harvesting those crops. So I think that's what's going to keep upward pressure on rates. I just don't see anything that can back off the pressure on reefer rates right now. Normally we see a decline in rates leading into Thanksgiving. It looks like it's going to remain elevated right through there.
Is there much, oh, sorry for cutting you off there, Ken, but I mean, my understanding with a lot of this reefer produce is there's basically no other mode that it can travel on, right? Like you're not, there's no substitution that you can make.
Yeah, some modes you can, like once temperatures get down below 50 degrees Fahrenheit, you can run potatoes in vented vans. You can port them on flat tops with tarps, onions in particular. So there is some exceptions to the rule. Generally, the colder weather is much kinder to a wider variety of produce. But then you still have the majority of that will have to run in refrigerated vans. And of course, you've got Christmas tree season coming up. A lot of that early season Christmas tree volume coming out of the Pacific Northwest will run in refrigerated vans typically to keep them in pretty good shape, especially for the export market. So lots of things happening now in the next 8 weeks in particular that's going to keep demand very high, I think, for refrigerated trailers at a regional, even 3-digit zip code level.
Are we seeing any use of like the refrigerated box cars? I mean, are they pulling those back into service, Dean, or what are those? Those are normally huge, right? Like 70-some feet.
Yeah, yes, exactly. Actually, I think they might be a little bit longer, but no, I haven't got any data on that, Ken.
I had heard earlier in the year that they were using them from LA to Chicago to get stuff like the imported, refrigerated foods, produce, and stuff like that. I didn't know if they were keeping it because they're very, very slow, right? I mean, that takes over a week, I would assume, to get from LA to Chicago.
Yeah, we did see some of that early in the year where they were offering a slow service for some of those refrigerated commodities out of the West Coast, but it was a 2-week transit time to New York. So there's very few commodities that can withstand that level of transit time.
There's no bueno. I mean, you got to imagine, this has come up a lot in conversations with shippers over the past couple of weeks. I mean, you're seeing these packed football stadiums, baseballs coming into the play. I mean, people need peppers and onions on their sausage sandwiches. I mean, there's the demand has to be, from like absolute levels, has to be higher for these things than it was last year, probably even the year prior.
Right.
Yeah. Because we haven't seen the grocery demand dip, but the commercial food service, kids are going back to school, universities have people on campus. There has to be, if you had like a crystal ball, there has to be an absolute increase in the amount of demand for produce and even probably like processed frozen food, right? Yep. Frozen palletized.
Yeah, we've seen a big resurgence in the catering industry here in the Northeast. So they're having record revenue weeks here in the Northeast. Some of the major catering companies, which you couldn't have said this time last year. So what we're seeing right now, though, is this. What our sort of anecdotal evidence is when we talk to some of the customers in that space, is they're getting in all of their celebrations, all of their weddings, all of their corporate events before winter hits. So it's not like they would normally spread it out because of the fear of more regulatory sort of mask mandates coming back in if the Delta variant doesn't sort of become contained,
or whatever the variant is by winter. What are we on, Mu?
Right.
Mu.
Yeah, it's crazy. I mean, while we're talking about this, we forgot earlier in the show, we got off to a bit of a rocky start. But if you have any questions, please feel free to get those in. Sooner the better. The past couple of shows, we ran short on time answering questions, and we have a few here. But please go ahead and drop them in the comment section below or the chat, and we'll marketing will get them over to us, and we'll read them and do our best to pretend like we know the answer.
My question is, I mean, we've now had nearly a year of just like intense capacity crunch kind of ping-ponging around the industry. What kind of motion would it take to, I mean, we're talking like there's got to be enough incentive for people to be expanding infrastructure or something. I don't know.
Where's it going to come from is the question.
Yeah.
Right.
So there's 400,000 trailing 12 months, roughly 400. I think it dipped below 4, but the number we were quoting before, it was 400,000 trucks ordered over the last 12 months. It's probably a little bit, like I said, probably like 375, 380. I have to go back and do the math. When are those going to hit the road? I get some of them are trickling in. Yeah, I'm sure like you can go to some Freightliner dealer and get one on the road. But if you're putting on 200 trucks to replace 100 that you're going to be taking out of service and incrementally adding 100 to meet this demand, I think it'd be quite the challenge to do that right now. I don't know about you, Dean. I haven't seen any hubbub from the railroads about expanding service.
No, most of the chatter there is about trying to ease the inland congestion port problems that they've been dealing with.
Yeah. Okay. So we have that. Truly, like, it's an interesting. We've had these discussions at length. I have not heard much about ocean capacity being constrained in terms of like not enough space on vessels. It's been about the load and unload, the congestion at the ports.
Right.
I mean, just putting boats out of sequence has a huge down. I mean, these are hundreds of thousands of containers we're talking about, right?
Right.
So a very small disruption in one of the big modes, a whole train, a whole boat, has massive ramifications for. I mean, think about like how many parcels could, or how many pallet positions could be on a whole ship's worth of freight.
Yeah.
So
the longest vessel in terms of delay right now off Long Beach is 4 weeks. It'll be 4 weeks tomorrow that one of these 8,000 TEU vessels dropped anchor. So when you start to think about that freight being locked up, and then large customers having, large trucking companies bringing in, chartering their own vessels to bring in their own customer freight, it makes you start to think about all of the small shippers who don't have the ability to do that, and how some of their important components are being held up in the supply chain. And I think, Ken, that's what we've seen in the spot market, right? When you start to have trucks out of sequence because of load imbalances, lane imbalances, commodity shortages, part loads, trucks going out on time but not full. It's a similar thing, I think, that's happened in the ocean side. You've had this, vehicles, trucks haven't been where the loads are, and the ships haven't been where they needed to be. Same as pallets. The pallet shortage was because pallets were tied up on freight in containers and not circulating through the market like they would normally.
Yeah. I guess that's because we're operational analysts, Dean. Isn't that what that one guy called us last year when we were operational analysts? I mean, you're not seeing the big picture. We were talking about lane imbalance for over a year now.
Right.
This stuff is all super crucial to understand, right? I mean, it cascades. I remember that graphic. I wish I could dig it up and find it, but it shows like all of the different trucks, full truckloads of freight that make up even a small size container ship. And just getting out of sequence or kind of diverting to a different port, that just has an immense ramification in and look, I think current estimates were under 100 million. We're now probably seeing over between 100 and $2 million worth of seasonal write-downs. Like those, what do we think's on that boat that's eight weeks overdue? I'm sure there's Halloween decorations. I'm sure there's pumpkin T-shirts, but Mommy's cutest little pumpkin onesies.
Right.
They're not going to hold that year over year, right? That's going to go to a liquidator.
And if you think about just the port of Long Beach, right? Look how landlocked that is. Like even though they're trying to ease congestion and widen the access for carriers around the clock, and work on weekends and creative things like that they do in other countries already. Just think about the physicality of getting more trucks in and out of an already congested Long Beach port. Like the logistics of this is staggering. I don't know how we clear this backlog, but we're already 30 vessels more than the record in February.
How many are we sitting?
I got the stats this morning off Kip Loud at 97 in port, 70 at anchor, and of that 70, 41 have anchored at sort of the approved areas, but there's 29 out in the drift areas, which means they're under power and just drifting, blowing in the wind. So 41 at anchor, 29 drifting, but there's 16 ships that are over 10,000 TEUs sitting at anchor, an average of 8.7 days.
So presumably 5,000 truckloads worth of freight each.
Right, correct.
TEU being a 28-foot equivalent.
And again, if you could find the chassis trailers, because chassis turn time is sort of doubled in some of the regions.
That's a great point. So we talk about, it's not just getting a thing off a boat. Think about there's 90 ships. Let's just say there were, on a typical day, there'd be 40 between at port and at anchor, right?
Right.
So if there's 50 out there, let's assume they're all, right, what are they averaging? 7,500 containers per?
Yep.
So 50 times 7,500. So that's 375,000 containers that are being, every single minute of every single day, are getting worse in terms of utilization.
Right.
And there's a finite number of containers available. And so it's not just chassis, it's these 250,000 to 500,000 containers are getting, imagine if you're a bit trying to relate this to a truckload carrier or an LTL carrier that might be listening to this. Imagine if you took 10% of your trailer pool and it got held up for an extra 3 to 5 days starting next week. What would that do to your operating efficiency? So think about that on an order of magnitude of 10, 20, 30, right? Because that's really how these large container vessels operate. That's just putting an absolute crush on. And all those containers are a mixture of how they're owned, right? Some are owned by internal marketing companies, some are owned by carriers, some are owned by the ship lines themselves. It's a mess.
Remember, it was only a few months ago that one of our largest truckload carriers reported in their earnings call that they had 30% of their trailing equipment tied up, or what they called out of operation, I think was the term they used, because they were sitting under loads that couldn't get unloaded at warehouses because people were having trouble trying to find labor to do so.
Yeah. Right. So the reason everyone's talking about this in our industry is because it's that big of a deal, and it's not going to clear up until after the holidays. We'll see it reduce most likely, right? Mm-hmm. Things will start to normalize, but I don't think we'll see this totally cleared up until the January slowdown.
We saw some of the experts in the marine industry, like Lars Jensen, suggested that we won't see any let up in the port congestion for at least 6 months, and not until we see the typical Chinese New Year shutdown in Asia before we'll start to see some sort of let off. But I think that's optimistic. Honestly,
like we crack jokes about Mummy's Little Pumpkin onesies, but at the end of the day, these apparel retailers are shifting to air freight to avoid.
Right.
And the cost of that is just insane. I mean, you're talking about, like, there was a really good book about ocean shipping, and I think even 10 years ago, it was under 10 cents to ship your average piece of apparel per, the shipping cost, if you allocated it, was well under 10 cents. That is not the case with air freight. Especially given some of the variable pricing practices that the big three have employed, the way that they're prioritizing freight, right? So what gets on the plane right now, so it's not just embargo versus non-embargo. You start to get to a point where the whole plane could be mainly priority and not much left for economy. So you're being forced to upgrade to priority, or you're getting constantly bumped. And that gets even more expensive, right? And then, I mean, I've heard, so first overnight, I only have experience with FedEx. First overnight's the thing that they'll turn a plane around for. Like, if a pallet gets left on the tarmac of first overnight, that's like the premier thing for all of FedEx. I'm hearing folks shipping basic stuff first overnight, which is just, like I said, other than a charter, it doesn't get much more expensive than that. So it'll be interesting to see how that manifests in higher prices at the shelf, the checkout.
Yep.
Inflation is fun. Right. It's very fun.
Yes.
All right, Ned, take it away. We got a bunch of questions come in.
Yes, we do. David Matheson says, news of LA Long Beach expanding hours. What should we expect? I feel like we've answered that a little bit.
Yeah.
But, I mean, how much push you can do. He also notes we're only as good as our weakest link, which is trucking capacity right now.
I don't know if I'd agree with that. I think the chain is a bunch of links on the ground. I mean, I think it's like when I walk into the room and the kids have completely disassembled their toys, and I'm just looking at a box of parts from 5 different toys, and it's like, okay. So let's just talk about it. So we have all these boats at anchor. That's not a trucking problem, not discreetly.
Sure.
We've got reduced man and woman power at the ports, getting crane operators, forklift operators, general laborers, and the longshoremen. Right, that's constrained. Near shore warehousing and cross docking is well over capacity. Right, they're transloading in abandoned Kmart parking lots.
Right, drayage
capacity is at all. You talk to these folks, who are we talking? I was talking to. Was it Next? What is it? Anyway, a major dray operator in Southern California.
Trucking. Yep.
Yeah, hearing reports that they're rejecting as many loads per day as they have trucks. I think it was them. I don't want to attribute to them if that was a fault, but that's not an uncommon story. Okay, so drayage is having problems. If you're not a big contract shipper, good luck getting intermodal capacity out of Southern California right now.
Right.
If you can even get it drayed to I guess it could just be translated. It doesn't matter.
Sure.
And then ultimately we get to the point where it's being picked up by over-the-road trucking. So yeah, I mean, they're all very weak links at the moment. It's still a chain. It's still working, but it's just, woof, that chain's being stretched.
Ken, I wonder if we'll see some sort of hours of service exemption for these local carriers over there, like the federal emergency type level. It may have happened already. I haven't caught up on that news in the last couple of days, but that's a distinct possibility.
Are they? And I have no idea if they are. So this isn't a leading question. I would have assumed they were exempt from the ELD mandate because they don't go more than 150 miles from their home base, and they're not interstate operators, most draymen.
Right. So they still have that 12-hour cap. They still have the weekly cap on hours, right? It's just their method of recording.
Correct.
Correct.
Yeah, so sorry. I went straight to...
Yeah.
Right.
So there makes maybe some expansion of some of those benefits there for them to help them, get more containers moved at different times of the day.
Stephen Nickel says, will we ever see rates where they were back in 2019, or have we set a new floor for rates moving forward with increased driver wages, tight capacity, and increasing fuel prices? I mean, it's going to be this is my take, but it's going to be a hot minute, and especially with the driver wage increases, it's going to be a real rough time to claw that back.
Mm-hmm. Mm-hmm. Yeah, I think I'd agree.
So we'll see, but
Yeah. Again, I have all of the empathy and compassion in the world for those that are moving freight right now, whether you're a trucking dispatcher, whether you're a dispatcher at a drayage company, whether you're trying to work at an intermodal. God, could you imagine the phone calls at an intermodal marketing company right now, the inbound phone calls that you're having to take?
Right.
If you're one of those supervisors, the Christmas party this year better be epic for your dispatchers and folks. Right. Hot tip.
Exactly.
Just print extra drink coupons.
Yes. Faith Dispatching Service. In the near future, do you all expect there will be data for box trucks? Probably not. Yeah, but we're working on it. I know we keep saying this.
Did I black out or something during Stefan's question about? Did we answer that one already?
We answered that. Yeah.
So I haven't. I must have spaced out for a minute. So one interesting, and if memory serves, Stefan's an analyst, so this might be right up his alley. So I've been looking at some of the correlations between year-over-year changes in contract rates for truckload, and one of the most valuable tools from my pricing history is the COLA, right? The cost of living adjustment from Social Security. And if you look at COLA as a 1 year leading indicator, and you lag back the year-over-year change in contract rates, the correlation is just wicked. Right? It's like 85% without doing any sort of feature engineering or tweaking or any kind of processing or outlier removal. So what's going to be interesting about that is we haven't seen a COLA above 6 in a very long time. And right now, the Social Security Administration is projecting a COLA of 6.2. My sort of layperson projection of that is it's probably only going to tick up as we see some of these retail price increases through the holidays. And we haven't really seen multiple quarters or years where inflation or COLA has been in these 5 to 7% levels since the 80s, right? So the last major COLA spike was after the 2008 Great Recession. I think it was 2009. It was 5.8 or something in that range. And it was a 1 year aberration. It kind of subsided after that. It's going to be really interesting to watch. They're going to release that number late this year for next, right? So everyone's cost of living is going to adjust next year. But they'll start issuing guidance on where they expect 22 to land. As analysts, as people who watch this market, that's going to be very interesting. And we need to watch that because that'll tell you how much, for lack of a better term, juice there is left in contract rates, how much more they could potentially go up as a kind of non-fundamental reaction to what's happening in the trucking market. So absent the supply and demand environment in trucking, outside inflation manifests itself much more in contract rates than it does spot. Right? If we look at since 2015, spot has oscillated in this kind of sinusoidal curve around nearly zero inflation. We've never really observed a period of this high of inflation in the historical record. Rate view is only 10, 11 years old. The Great Recession was 12 years ago, right? So I'm issuing the same caution to this group as I do our internal folks around we need to keep a very close eye on what macroeconomic inflation is doing as it pertains to trucking rates because it will play a factor. The guys and gals putting the tires and changing the brakes on your truck are paying more for milk and gas and bread. Inflation is this kind of universal pressure on the economy, all facets of the economy. So it's something we just need to keep in mind because I don't know, to your point, it's going to be really hard to claw back these pay increases and whatnot, but those pay increases are going to feel a lot less like pay increases if we see a couple years of even 3 to 5% inflation. We've been in a zero inflation environment the last 5 to 7 years, frankly.
Yeah,
right.
COLA was 0% at least two or three of the last few years. So just something to keep in mind. It's a great question. And sorry, I went a little bit long-winded there, but I think it's something we should all kind of, if you're watching this program, it's important for you to pay attention to that number. And it's a very simple number to digest. Put it in your bookmarks, put it in your favorites, keep an eye on it.
Good work.
Do we have time for 2 more questions?
Let her rip, Tater Chip.
Adam Map, I think, Mop, private. Are you guys tracking progress on autonomous trucking? number of trucks, number of loads they pull, miles they drive. I'm not.
No.
It feels it feels a little premature to be tracking that. It
A lot
could
of the data
be
is proprietary too, Ned. So from some of the players that are doing the regional trials.
Mm-hmm. I don't really have any other comment on that. I mean, it could be a really big
truck
thing.
Mm-hmm.
The which
0. It rounds to 0.
Yeah.
I mean, it's cool to talk about, right?
Yeah.
But I mean, 0.
Yeah.
If you had to round to the nearest 1,000,000 tons of freight, or I'm sorry, you round to the nearest 1,000 tons of freight moved. Still, I mean, it's cool. Again, it's the wave of the future. I'm not dismissing it. I'm not tax yellow cab and the advent of Uber. I'm just saying, in the macro sense of everything happening right now, sure, it's cool. Just like those Boston Dynamics robots that look like dogs are cool. But I mean, I think we got big problems right now.
And the thing about exponential growth is that the early part of the exponential growth is pretty slow. So if it's going to be takeoff, there's definitely going to be some signs of it sooner. Or not sooner, but there will be signs of it in advance of any kind of like a big exponent. David Miller is having a hard time finding reefers. Yeah.
I think, honestly, where this bubbled up and where our question stemmed from today is, I mean, typically you do see that dip, and I've been asking proactively brokers and shippers and carriers what they're seeing. Like, we have not seen that post 4th of July let off with produce. I think it was a really good, again, I'm not a what is the scientist even that studies farm crop yields? I don't know. Agricultural.
Agronomist.
I'm, given that I didn't even know what it was called, I'm clearly not an agronomist. But, from what I understand, it was a good year for a lot of these crops, right? I guess the droughts weren't as bad. I don't know.
Yeah,
I'm over my skis at this point. All I know is I was told from multiple folks that it was a really good year, and then it bridged them over to the fall crops coming in. So, plus you have that substitute need for reefers being pulled into dry van loads, and it's just been extraordinarily tight.
Yep.
Yeah.
And I think the other part that I'm seeing, just sort of anecdotally again from my circle, is a lot more power only. So you're seeing a lot more owner operators moving power only loads, where you've got these large fleets that have got, typical trailer pools in the range of 4 trailers to every powered unit. Desperate need in e-commerce to just move trailers using power only. So that could be part of the reason we're seeing less carriers just available generally.
That sounds right.
Yeah. We had one more question or comment that came in via email a bit ago, and I want to make sure that we address it. If you will give me 2 shakes to pull it up. Sam Tibbs. He emailed us from Cloud Trucks to ask us to give a score, like an accuracy score for the short-term model. And I think that's a good idea, but I just wanted to call that out and say that I'll get on that, and we hear you.
Thank you, Sam.
Friend of the show.
Mm-hmm.
Yes.
All right. Is that all we have?
That's a lot.
All right. And again, I apologize for the rough start. That happens. Last day of summer. We're all a little grumpy. But so, Dean, where are you going to be? You have Thursday, you have Saturday. Can you talk us through where we can find more Croak?
Yeah. On the OOIDA Landline Now show at 7 p.m. Eastern tomorrow night. That's Wednesday evening. And then on Sirius XM on Radio Nemo at 8 a.m. Eastern with Jimmy Mack.
Cool. Like I said, CSCMP, TCA. There's a McLeod. That already happened. What's it called? TIA show coming up. I'll be on a panel at that in Texas next month. I believe they're doing a hybrid event, so if you don't feel comfortable traveling, I think you can still tune in. We're planning another TIA webinar this quarter. That's going to be really fun. The last one about RFPs was really good. I think you can go download the recorded version of that. It was tons of really, really great questions. I think we actually went overtime on questions. But with that, we will be back here next week at 10 a.m. Eastern on Tuesday. And I think that's all we have this week. Have a great rest of your week, everyone, and we'll talk to you then. Bye.
Thank you.
Bye, everybody.
Bye, everybody.